Welcome to our podcast, where we share our professional knowledge and experience for those considering commercial mortgages or loans. If you are in need of commercial mortgages or loans, contact us for a no-obligation free consultation. Let's start today's episode. Understanding asset finance. Asset finance is a method that allows you to acquire assets, such as equipment or vehicles, without having to pay the full cost upfront. Instead, the asset is financed through a loan or lease agreement, and you make regular payments to the finance provider. In this section, we will explain the basics of asset finance and how it can benefit your business. Firstly, it is essential to identify the type of asset you need for your business. This could be anything from machinery, vehicles, or even software. Once you know what you require, you can approach a finance provider to discuss your options. There are various types of asset finance, such as hire purchase, leasing, or sale, and leaseback too. Each of these options has its advantages and disadvantages, and it's crucial to choose the right one for your specific needs. One of the main benefits of asset finance is that it allows you to spread the cost of acquiring an asset over a period. This can significantly improve your cash flow, as you won't need to make a large upfront payment. Additionally, asset finance often comes with flexible repayment terms, allowing you to match the repayments with your business's cash flow. This way, you can grow your business without the financial burden of purchasing costly assets outright. Another advantage of using asset finance is that it often has a quicker approval process compared to traditional loans. This means you can acquire the assets you need quickly and get your business up and running without wasting time waiting for loan approvals. Additionally, some finance providers may offer extra support, such as assisting with maintenance or upgrades. In conclusion, asset finance can be a valuable tool for your business, helping you obtain the necessary assets without the need for a large upfront payment. By carefully selecting the right finance provider and type of asset finance, you can grow your business and improve your cash flow. Just make sure to thoroughly research your options and weigh the pros and cons before committing to any asset finance agreement. Types of asset finance. When it comes to asset finance, there are several options available to suit your business needs. In this section, we'll briefly discuss the most common types: lease, hire purchase, finance lease, and operating lease. Lease. In a lease agreement, you pay for the use of an asset over a period of time without the intention of owning it. It allows your business to utilize equipment, vehicles, or other assets without bearing the full financial responsibility of ownership. Hire purchase. Hire purchase is a popular option if you intend to own the asset at the end of the agreement. You make fixed monthly payments with added interest for a set term, and upon completion, the asset is yours. It helps your business acquire assets without impacting cash flow. Finance lease. A finance lease allows you to choose between owning the asset at the end by paying a residual amount or returning the asset to the finance company. You can benefit from the use of the asset for a specific period with the potential of ownership, while spreading the cost over time. Operating lease. With an operating lease, you rent the asset for a fixed term that's typically shorter than the asset's useful life. You won't have the option to own the asset at the end of the lease. It is ideal for businesses that want to maximize equipment usage without the commitment of ownership. To find the best asset finance option for your business, consider your company's financial situation, its plans for growth, and the type of assets you need. A suitable choice will help you achieve your goals while managing your assets efficiently. Advantages and disadvantages of asset finance. Asset finance is an essential tool that can provide your business with the necessary funds to purchase or lease assets such as equipment, machinery, or vehicles. It offers several advantages and disadvantages, which we shall discuss in a confident, knowledgeable, neutral, and clear tone. Advantages of asset finance. Improves cash flow. Utilizing asset finance can help improve your business's cash flow, as you're not required to make large upfront payments to acquire essential assets. Instead, payments can be made in regular installments, allowing you to manage your finances more effectively. Preserves working capital. Since you don't need to spend your working capital on acquiring assets, you can use it for other aspects of your business, such as marketing, hiring, and R&D. Access to a wide range of assets. Asset finance enables you to acquire various assets, from vehicles and machinery to IT equipment and specialized tooling. Tax benefits. depending on the type of asset finance arrangement, your business may be able to benefit from tax advantages, such as claiming capital allowance or writing off rental payments as operating expenses. Disadvantages of asset finance. Potential higher overall cost. Depending on the interest rates and terms of the financing agreement, you may end up paying more for the asset over the long term compared to if you had purchased it outright. Ownership uncertainty. With certain asset finance arrangements, such as leasing, your business may not own the asset at the end of the term. Therefore, you may need to enter a new agreement or make a final payment to retain the asset. Risk of asset devaluation. Some financed assets may lose value over time, potentially leaving you paying more in finance costs than the asset is worth on the market. Restrictions on asset use. Depending on the terms of your financing agreement, there may be restrictions on how you use the asset, such as mileage restrictions on vehicles or limitations on modifications. In conclusion, asset finance can offer several benefits to your business, such as improved cash flow, access to a wide range of assets, and potential tax advantages. However, it also has its drawbacks, like potentially higher overall costs, ownership uncertainty, and restrictions on asset use. It is important to carefully consider these factors before entering into an asset finance agreement to ensure it aligns with your business's needs and goals. Process of acquiring asset finance. When looking to acquire asset finance, the first step is to determine the specific assets or equipment you require for your business. This could include new machinery, vehicles, technology, or other capital equipment that will help improve your operations. Once you have identified the assets, approach a reputable asset finance provider who specializes in the type of financing you require. There are different types of asset finance available, such as hire purchase, finance lease, operating lease, and asset-backed lending. It is important to assess the pros and cons of each option and choose the one that best suits your business needs and cash flow constraints. Before extending a loan, the finance provider will assess your creditworthiness. This may involve evaluating your business financial statements, credit history, and existing debts. Be prepared to provide documentation related to your business operations, including income statements and balance sheets. Lenders may also require a form of security, such as the assets being financed, to mitigate their risk. As you negotiate the financing terms, ensure that the repayment schedule, interest rates, and any additional fees are clearly understood. It is essential to consider how the repayments will fit into your cash flow and budget to avoid any financial strain on your business. Once the asset finance agreement is finalized, you can proceed with acquiring the equipment or assets. The lender may directly pay the supplier or reimburse you if you have already made the purchase. As you make repayments, you'll either gradually gain ownership of the asset, in the case of hire purchase, or continue to rent it for an agreed term, in the case of a lease. By following these steps, you can secure the necessary asset finance to acquire the vital equipment and assets your business needs to grow and thrive, while preserving cash flow and maintaining financial stability. Remember to always consult with your financial advisor to ensure the chosen financing option aligns with your business's financial goals and objectives. Repayments and interest management. Asset finance is a versatile financial solution that allows businesses to acquire assets and spread the cost over a specified period. It is essential to understand repayments and interest management to maximize the benefits and minimize risks associated with this type of borrowing. When entering an asset finance agreement, you will typically have to repay the loan in monthly installments, known as monthly repayments. These repayments will consist of both the principal amount borrowed and the interest charged on the outstanding balance. The interest rate can vary depending on the lender, your creditworthiness, and the type of asset being financed. It is crucial to understand the interest rate and compare different offers so that you can make an informed decision. To manage your repayments and interest effectively, it is essential to consider the following points. Budgeting. Plan your finances by analyzing the cash flow and working out how much you can afford for monthly repayments. Set aside funds specifically for this purpose and stick to your budget to avoid any potential financial strain. Repayment frequency. Ensure that the repayment frequency aligns with your income stream. For example, if your business receives income on a quarterly basis, you might opt for quarterly repayments rather than monthly ones. Fixed or variable interest rate. Choose between a fixed or variable interest rate as per your risk appetite. A fixed rate offers certainty, whereas a variable rate may decrease or increase depending on market conditions. It's crucial to weigh up the potential risks and rewards while making this decision. Early repayments. If you find that your business has excess cash, you can consider making additional payments to reduce the principal amount and eventually decrease the interest accrued. However, be aware of any penalties or restrictions that may apply for early repayments as per the terms and conditions of your agreement. Review and monitor. Regularly review your asset finance agreement and ensure that you are on track with your repayments. Monitor the interest rates and consider refinancing if better opportunities become available. By effectively managing repayments and interest in your asset finance agreement, you can ensure that your business benefits from the acquired asset while minimizing the financial burden. Stay informed and vigilant about the terms of your agreement, and be proactive in addressing potential challenges that may arise in the repayment process. Impact on cash flow and balance sheet. When considering asset finance, it is essential to understand its impact on your cash flow and balance sheet. This will help you make informed decisions and ensure that your business remains financially stable. Asset financing helps in improving cash flow by allowing you to acquire assets without a large upfront capital outlay. By choosing an appropriate financing option like leasing or hire purchase, you can spread the cost of the asset over several years or months. This ensures that your working capital remains intact and can be used for other operational expenses. Additionally, regular and predictable payments can help you manage your cash flow more effectively. For your working capital, asset financing plays a significant role. Working capital represents the difference between your current assets and current liabilities. By opting for asset financing, you can preserve your working capital, which is crucial for day-to-day business operations and fulfilling short-term obligations. Moreover, a stable and well-managed working capital enhances your business's financial health and can attract more investors and partners. The balance sheet reflects your company's financial position, showing its assets, liabilities, and shareholders' equity. Asset financing impacts the balance sheet in different ways, depending on the financing option chosen. For example, in a leasing arrangement, the leased asset is generally not recorded on your balance sheet. Instead, lease payments are recorded as an expense in your income statement. This keeps your balance sheet free from additional liabilities and may improve your financial ratios, such as debt to equity. In a hire purchase agreement, the asset is recognized in your balance sheet as it becomes your property over time. As you make payments, the asset's value is depreciated, and a corresponding liability for any outstanding payments is recorded. This adds to both your assets and liabilities, potentially affecting your financial ratios. Choosing the right asset financing option is crucial for your cash flow, working capital, and balance sheet health. By analyzing the impact of each option on your financial position and working with professionals, you can make informed decisions that support your business's growth and stability. Tax considerations in asset finance. When exploring asset finance solutions for your business, it is crucial to consider the tax implications associated with various finance options. Understanding the tax treatment of your chosen asset finance solution can help you make informed decisions and capitalize on potential tax benefits. In the realm of asset finance, leasing and hire purchase are two commonly used methods. The tax treatment for each method varies, so let's examine them both. Leasing. When you lease an asset, you are essentially renting it for a specified period. In this case, the lessor, the finance provider, retains ownership of the asset. Lease payments are generally considered as operating expenses for your business. Consequently, you can usually deduct the full lease payment amount from your taxable income, subject to certain conditions. This can lead to significant tax savings for your business. VAT is another important factor to consider when leasing assets. In most cases, you can reclaim the VAT on your lease payments. However, it is important to note that the VAT reclaim rules can vary depending on the type of lease and the specific conditions of the agreement. Hire purchase. In a hire purchase agreement, you obtain the ownership of the asset at the end of the contract period after making a series of payments to the finance provider. The tax treatment of hire purchase agreements primarily depends on your business's accounting methods. The asset in question is typically shown on your balance sheet as a capital expense. As a result, your business can claim capital allowances to offset the cost of the asset against your taxable income. It is essential to bear in mind that the specific capital allowance rates vary depending on the type of asset. Regarding VAT, you typically pay the VAT amount upfront in a hire purchase agreement. You may then claim back the VAT amount, subject to the standard VAT recovery rules applicable to your business. In conclusion, when evaluating asset finance options, it is essential to consider the tax implications associated with your chosen method. By understanding the tax treatment of leasing and hire purchase agreements, you can make well-informed decisions that maximize tax benefits and facilitate your business's growth. Asset refinancing options. When considering asset refinancing options, you have several ways to free up cash from the assets your business already owns. This financing method allows you to borrow against assets you already possess, such as vehicles, equipment, machinery, or raw materials. In doing so, you can optimize the value of your assets and improve your cash flow situation. One common option for asset refinancing is a sale and leaseback arrangement. In this scenario, you sell your assets to a finance company and then lease them back for a fixed period. This allows you to maintain the use of the assets while also obtaining a cash injection for your business. Keep in mind that the borrowing amount will be limited by the value of the assets you offer as collateral, so ensure there is enough equity in the item to unlock the required amount of cash. Another refinancing option is to refinance using a secured loan. This type of loan uses your business's assets as collateral, offering a lower interest rate due to the reduced risk for the lender. It's important to assess the risk involved with this type of refinancing, as failing to repay the loan could result in the loss of your assets. When comparing asset refinancing options, it's essential to consider the following factors. Interest rates. Look for competitive interest rates to keep your borrowing costs low. Loan terms. Ensure the repayment term is suitable for your business's cash flow situation. Flexibility. Some lenders may offer flexible repayment options, allowing you to tailor the loan to your business needs. Asset refinancing can be a powerful financing tool for your business, allowing you to unlock cash tied up in assets while still maintaining their use. By carefully considering the various options available, you can choose a refinancing solution that best meets your business's needs too. Role of banks in asset finance. Banks play a vital role in providing asset finance solutions to businesses. With asset finance, you can acquire the equipment, vehicles, or machinery your business needs without impacting your cash flow. In this section, we discuss the involvement of banks in asset finance and how it can benefit your business. Banks offer various asset finance options, such as hire purchase, leasing, and finance leases. In a hire purchase arrangement, your bank may provide the necessary funds for you to acquire the asset. You then pay the bank in regular installments, eventually owning the asset outright. This can be ideal for purchasing high-value items like factory machinery or commercial vehicles. Leasing is another common asset finance option provided by banks. In this case, the bank buys the equipment and leases it to your business for a specific period. You make regular payments in exchange for using the asset. At the end of the lease term, you can choose to purchase the asset, continue leasing it, or return it to the bank. Leasing offers flexibility, allowing you to upgrade to newer equipment without large upfront costs. Finance leases are a hybrid between hire purchase and leasing. In this scenario, the bank buys the asset but retains ownership throughout the lease. You make regular payments while enjoying full use of the asset. Often, a substantial portion of the asset's value is covered during the lease term, with the option to purchase it at a reduced price at the end. Asset finance from banks can be more advantageous than traditional bank loans in certain situations. With bank loans, you borrow a lump sum to fund various business needs, but asset finance helps you focus on asset acquisition or improvement. Additionally, the installment payment structure can lead to better cash flow management and increased working capital for your business. Choosing the right bank for asset finance depends on various factors, such as your business's unique requirements and the bank's offerings. It is essential for you to carefully assess your needs, evaluate the available options, and select the most suitable solution to ensure the success and growth of your business. Understanding leasing of different assets. When considering asset finance, it's important for you to understand the various types of assets that can be leased. leasing allows your business to obtain the necessary equipment without having to make a huge upfront investment. Assets that can be leased often include vehicles. Commercial vehicles and cars can be leased, providing your business with a more manageable way of maintaining a fleet without having to deal with the burden of vehicle ownership. Machinery. From manufacturing equipment to agricultural machinery, leasing such specialized machinery can help your business stay up to date with the latest technology, while keeping costs manageable too. Plant and machinery. Leasing plant and machinery, such as construction or industrial equipment, can help your business save on costs, enabling you to invest the funds in other areas that might be crucial for growth. Furniture. Leasing furniture, particularly for offices or retail spaces, can be a cost-effective solution when setting up a new space or if your business frequently moves between locations. IT equipment. Information technology equipment, such as computer hardware and software, can be leased to help your business adapt to the rapidly evolving world of technology. By leasing assets, you can generally expect smaller monthly payments compared to purchasing the assets outright, helping your cash flow. It may also provide you with tax benefits, as leasing payments are often considered a business expense. However, keep in mind that when leasing, the ownership of the asset remains with the leasing company, which might limit the flexibility of using or modifying the assets to suit your specific business needs. Overall, understanding the leasing options available for different types of assets can help you make informed decisions on the best asset finance solutions for your business. Asset finance for various businesses. Asset finance can be a beneficial solution for businesses of different types and sizes, including SMEs, new businesses, limited companies, and public limited companies. The primary objective of asset finance is to help you acquire, replace, or release capital from assets without putting undue strain on your cash flow. This can be particularly advantageous for businesses looking to grow, improve efficiency, or invest in new equipment and machinery. For SMEs, asset finance can ease the financial burden of purchasing new assets by allowing you to spread the cost over a longer period. This can help you maintain a healthy cash flow while obtaining the equipment necessary for your business operations. Also, asset finance options like leasing and hire purchase can provide tax advantages, and it might be easier for SMEs to obtain asset finance compared to traditional loans. New businesses often struggle to secure funding, especially when it comes to obtaining the assets required for starting up. Asset finance can be a viable option for your new venture since it avoids the need for a large upfront payment. You can focus on establishing your business and generating revenue while gradually paying for the assets you require. For limited companies, asset finance provides a flexible and less risky alternative to taking out a business loan. Since the asset itself is used as security for the loan, your company's credit rating can remain less affected if financial difficulties were to arise. Additionally, depending on the type of asset finance chosen, your business might be able to improve its cash flow by spreading payments over an agreed period. Public limited companies can also benefit from asset finance by allowing them to invest in assets, without reducing their working capital significantly. Asset finance can free up funds for other investments or projects, particularly useful for public limited companies that need to invest in large-scale assets or machinery. In conclusion, asset finance offers a range of advantages for different types of businesses, from startups to public companies. By using asset finance, you can acquire essential equipment and release capital from your existing assets, resulting in a better managed cash flow and more opportunities for growth and investment. Legal and contractual aspects of asset finance. When considering asset finance, it is essential for you to understand the legal and contractual aspects involved. Asset finance deals with financing various types of assets, ranging from large ticket items like ships and aircraft to smaller equipment such as buses and machinery. These arrangements can be done through secured lending or leasing. In a typical asset finance structure, the funder purchases the asset from the supplier and leases it to you in exchange for periodic payments. This is often called a lease or hire agreement too. There are two main types of asset finance structures: contract hire and finance lease. In a contract hire agreement, your business can use the asset without actually owning it. The liability and responsibility for maintaining and servicing the asset generally remains with the lessor. At the end of the contract hire term, you have the option to return the asset or negotiate a new agreement for On the other hand, a finance lease allows your business to acquire the asset without an upfront payment. Instead, you make fixed monthly payments to the lessor over an agreed-upon lease term. The ownership of the asset may be transferred to you at the end of the lease term for a nominal fee, or you may continue to lease the equipment. 5. To protect your interests, it is crucial to carefully review your agreement's terms and conditions, focusing on aspects such as payment obligations, maintenance responsibilities, and liability for loss or damage. Ensure that you are aware of the asset's ownership and any conditions for eventual transfer should you opt for a finance lease. In summary, understanding the legal and contractual aspects of asset finance, including the differences between contract hire and finance lease, is vital for your business. A well-structured agreement can provide flexible financing solutions, allowing your business to grow with no unnecessary financial constraints. Use our experience and knowledge to place your application with the most suitable lender, based on your circumstances. What are the main types of asset financing? Asset financing is an umbrella term that covers various financing options catered to specific business assets. The main types include leasing, hire purchase, and refinancing. Leasing lets you use an asset without owning it, while hire purchase allows you to eventually own the asset after a series of payments. Refinancing involves raising funds against an existing asset. 1. What are the advantages and disadvantages of asset finance? Asset finance offers several advantages, such as improved cash flow, access to the latest equipment, tax benefits, and flexibility in payment terms. However, it isn't without its disadvantages. Asset finance can be more expensive than traditional loans, and not all assets are easy to finance, especially if they lose value quickly too. How can startups benefit? Preserving working capital, accessing the latest equipment, and providing a potential tax advantage. It allows startups to invest in necessary equipment without tying up significant cash flow. 3. Which companies provide asset financing services? Numerous companies offer asset financing services, including banks, specialized finance providers, and alternative lenders. 4, 5, 6. How does asset finance compare to bank loans? Asset finance is often easier to obtain than bank loans as it's secured against the asset. This security means lenders face a lower risk, possibly resulting in quicker approval and better interest rates. However, asset finance can potentially be more expensive in the long run, depending on the terms. 7. Can you provide examples of common asset finance products? Common asset finance products include commercial vehicles, cars, plant machinery, office equipment, and factory machinery. 8. Asset finance can be tailored to suit various industries and business requirements, making it a versatile option for acquiring and financing essential equipment. For more information, you can contact us by clicking the link in the description of this video. Thank you for listening to our podcast. We look forward to coming together again in the next episode to share more information and experience with you. For now, goodbye.